Everybody, it is Saturday, the 18th of May, 2019. The market is closed for the week here, and it was a negative one for the most part. Looking down the columns, you can see we had oil was up, bonds were up, and energy stocks, as well as the volatility index. Otherwise, it was a week where we are pulling back a little bit. So let's take a look at the action. Daily time frame, we are below a declining 20-day moving average. We haven't had that condition since back in December, and it's worth noting. The 50-day moving average is still heading higher, and we are, of course, above the 200-day moving average and the year-to-date volume-weighted average price. So on the downside, if we see further selling, this looks like the area where we have the strongest likelihood for support to be found. Looking at a 30-minute time frame, we can see that we are still above that 5-day moving average. The 5-day moving average is declining. We never had a higher high and higher low above this rising 5-day moving average, so officially we're still looking at this as cautious here. That's the volume weighted average price off the all-time high. We flirted with that a little bit this week, and the biggest level that we need to see this market get back above, of course, is about 289, 89 and a half. What we could see possibly this week, for a bullish scenario, would be for the market to do something that looks like this, which is to rally back up into this area and then maybe start to move higher. If that's the case, then what we would do is raise our stops up underneath the successive higher lows and see what the market gave us from there. But until we get up through that level, this is the area that we're looking at, that it needs to get up beyond this this source of supply in this area for the buyers to regain control. For the Nasdaq, we obviously lost some ground here as well, and we're also below a declining 20-day moving average for the first time since late January. It doesn't mean the market will continue lower. It means, though, that we have to be a little bit more cautious. The 30-minute time frame here for the Nasdaq, we can see it's kind of the same story. There's the volume weighted average price from the all-time high, and then for this past week, we've got that volume weighted average price. What we want to see hold as support is really about 180, 175 to 182. If it can hold above that, maybe make a higher low, then it could push up through this level and we could be back on our way to the upside, because overall the upside still looks reasonable. So if we get back above that 20-day moving average, and then we could be in a position to continue to move higher. But until so, we're still a little bit cautious on this market overall. So far, we've seen the Russell 2000 finding buyers at the year-to-date volume-weighted average price, and we saw that again this week. Now, if we're to break below that in the coming week, then look for the 150 level. It's a round number, plus it's the volume weighted average price off the December lows. So look for that to be tested. But we're back below a declining 20, 50, and 200-day moving average in this Russell 2000. And this is the group that just 3 weeks ago was looking like it wanted to break out and lead this market higher. Now it's looking more like a failed move. So back over to the 30-minute time frame, we're back below the 5-day moving average, which is declining. We're below the volume weighted average price from the beginning of the month, and that was almost precise level of supply here. So what could change this and move us back to the upside would be for a close back above 157. Semiconductors got hit pretty hard this week, and they are working their way down to the conjunction of the volume weighted average price year to date. That's that thick blue line, and the volume weighted average price off the December low. That's the purple thin line. So that looks realistic to be hit probably in the next few days at 104, and below that we have the 200-day moving average. So the daily time frame is obviously looking like it's still pulling back, and that's the same story that we see here, of course, on a 30-minute time frame, where each candle represents 30 minutes of data. So what we can do in there is just open that back up, and there you can see each individual day. We came up to and through the declining 5-day moving average, but we never saw that 5-day moving average flatten out. So it's still guilty till proven innocent, most likely headed for that 104-ish level. The Biotechs continue to be a broken group, and they did lose some further ground here this week. It didn't get smashed altogether, and this is where Alpha Trend subscribers covered some of their short position in here, actually, on that day lower, the day that it broke. Midday, we covered part of it in there. because where had it come from? We didn't want to be the people who short this breakdown. That's always a foolish move. Not always, but generally a foolish move. So we covered some in on this day. Right in here was it hit daily S2 that day, I think it was. But the point is, it's trying to recover this past week. 103, back below 103. You know, if it's to stay below 103 for more than a half hour or so, then I think you could put on a fresh short position here, or reshort what you might have already covered in the case of the Biotechs, because this daily chart is clearly just an ugly, ugly chart. The financials did gain a little bit of ground, actually. You wouldn't know it by looking at this daily chart because it's just a big giant mess here, below a 20-day moving average, above a 50-day moving average, trying to hold the VWAP from this low, and looking at a 30-minute time frame. It doesn't make a whole lot of sense to be involved in this market from what I can see with these daily large gaps in each direction, so I haven't done anything in there. If you take a look at Apple, I had pointed out on Twitter this week that the stock was trying to hold the volume weighted average price from this earnings report right here, and on a closing basis it did. But if it's to break down, 180 does not look unreasonable for Apple. That's the year-to-date volume-weighted average price, and approximately, of course, the volume-weighted average price from this low. They were only 2 days apart. So the 30-minute time frame, we have a declining 5-day moving average, and we have a stock that's in trouble here. I would not be looking for Apple to make a quick recovery the way it can sometimes. The shares of Tesla I had pointed out as well, interestingly, because the volume weighted average price from the IPO. So the average price that the stock has traded at since the very first day is up here at about 225, and we closed at 211. So what that means is the average participant over the period of its entire life is losing money right now. The average transaction has occurred at 225, and here we are at 211. That does not bode well for Tesla. Now, would I short here? Of course not. Look where it's just come from. To me, it's come too far too fast to short, but you have to look at it and say, you know, maybe it gets a bounce up to that 225 level, and that acts as an area of supply. Then you could see an opportunity to sell short. Anyways, I'm going to wrap it up here, and thanks for tuning in. Have a good weekend.